Welcome, everybody. My name is Joe Mossbrook, and I am the manager of the HabPro, director manager of the HabPro program here at NSM. It's an exciting day for us. Today is our first webinar, and we have over 350 participants. That's a record for us here at NSM. So thank you for joining and your interest in learning more about the Habitational program, also known as HabPro. So today, I would like to introduce my colleagues and fellow presenters, Todd Van Gieri, who's Underwriting Manager, HabPro, Davis Halley, who's Senior Production Underwriter. They will be joining us today a little bit later. First, I'd like to talk about today's agenda. HabPro introduction. We're going to talk about a high-level overview of our product, get into some of the coverages, and Todd will talk about best chances of getting a quote, and then he'll get into and discuss accounts that were eligible accounts, ineligible, or classes that we try to avoid. And then Davis will jump in, and then he'll talk about review of the key coverages that we offer here, and then also recent program enhancements that are part of our program. Then we'll talk about some recent wins, some accounts we put on recently that we'd like to discuss and get you a little bit better feel for what we're targeting from a risk and a class basis. Then we'll talk about how to get appointed and win the business. And then we'll open it up to some Q&A at the end. I know that's very important. We're laying out the groundwork for a specialty product, but we also would love to hear the questions and give you some answers to those at the end. So first, let's talk about HabPro. Let's talk about NSM as a whole. I'll jump into specifics about HabPro a little bit, but let me tell you about NSM and that we're a leader in the specialty insurance market. Some refer to NSM as Norman Spencer McKernan. I look at it and it stands for niche specialty markets. We have over $1.3 billion in premium. I know that may surprise some of you, but we really have gained traction over three decades of experience in the program space. We have footprints in the US and in the UK. We have over 25 B2B and B2C programs that spread out over those 14 offices. So the key to success is really our incredible long-standing relationships with our carriers. NSM is really built for success. So let's really jump into really what is HabPro. And as we talk about the HabPro itself, I always love to give a little bit of a plug and a snapshot of other programs that we have to offer here at NSM. So some of them listed here: collector car program. We have a pet product called Embrace for pet insurance. All comp or staffing, that supports really all programs from a workers' comp perspective, and they do have a specialty in equine. We have a care provider program that really focuses on religious organizations, schools, shelters, and then before and after school programs. They offer package, monoline, property and GL, and some professional coverages. And then we have KVK. They offer a garage program, dealer open lot, and then some towing and APD coverages. So we have PUA listed here, which is really about all professional lines coverages. Sports and wellness, which is another one of our really fast-growing programs at NSM, and they focus on gyms, instructional classes and events, that kind of sports environment. So I really, we want to get down to talking about NSM as a whole, and now our mission at NSM, and specific to us here at HabPro. Let me say this, that just as it's listed here, we want to provide the best-in-class insurance solutions on a non-admitted basis for condos and apartment risks. We feel that we built a really good team of individuals that have underwriting experience, long-term working in the industry. We also have a product that's really broad-based, that has enhanced coverages, has specialized into the real estate segment. So we also want to work with agents that have a flow of business, and for that, we really want to focus on those key agents that work in the field of habitational. We see that we focus on the apartments, the condos, the multifamily dwellings, and get a constant flow of business from each partner. Sometimes we look at it as doing more with less. So again, we focus on the non-coastal business. With Davis and Todd, we'll get into it a little bit later. But our average account is 1 to 5 locations with like 1 to 5 buildings at each location. So we target a package approach, but we can also do monoline property. We don't really look to do monoline GL, but we look at as HabPro is offering 3 components to being the best in class. One is the product itself. We work off an ISO-based format with broad coverages. We have a property enhancement form that you'll hear in a little bit. And that property enhancement form has like 20 ancillary type coverages, and really to meet the apartment condo needs of the insured. And then I think that the second part of what really separates us from the industry is our people. Our people are most of us are underwriters that have been working with on the carrier side for quite often. So we have dedicated individuals. We focus on a team basis, and that team is we have a team Van Gieri, a team Holly, and then a team Matthews. And what they focus on is they're like the hunters of our business. They go out and they work and build strong relationships with each partner. And the purpose of breaking out this team is to focus on new business, each of those teams, to create consistency with each partner, to be able to go out and understand and build relationships, knowing where each partner operates, the states in which they operate, knowing what accounts to write on what side of the tracks. So as we target that underserved business, we don't want to be a small, we know you have access to small binding authority business. We know that there's brokers out there that do the large schedules, the large limit business. We believe we target that middle market underserved industry where average premiums are 25 to 35,000. Yes, we write $5,000 policies. Absolutely. We have authority to write to up to $100,000 in premium. And if there's an account that we feel that is an average or above average in nature, well, we can always refer those accounts into our carrier. We have a dedicated Arch referral underwriter that we feel has the same enthusiasm of turning around the business, getting an opportunity and giving it the best chance to quote and service our partners. So this our team here, made up of new business people, made up of renewals, which we look at as our farmers in the business. Next slide. So let's talk about our eligible classes, and I'd like to turn that over to Todd Van Gieri to get a little bit more in depth into the type of business that we target. Todd?
Great, thanks for your intro, Joe. I'm Todd Van Gieri. I'm the underwriting manager here at HabPro. I've been here since the beginning with Joe, so it's been about 4 years now. I just want to say thank you to everybody that's on the call. It's very humbling to have about 350 people interested in what we have to say about how our program's going. So again, very humbling. Just wanted to say thanks to everybody. Before we get into the eligible classes, I want to talk a little bit about how our submission process works. Many of you probably work with an underwriter now. As you know, agents come on board, everybody gets assigned to an underwriter. So it's always best to, when you send a submission in, CC your underwriter, especially if it's like a hot button topic so they know it's out there. But it's also key to send it to HabPro, HABPRO at nsminc.com, because then the risk goes right into our submission clearance system. That way we don't accidentally miss something that may be sitting in our email. So once it comes in, it goes through our clearance system. It will get assigned to an actual underwriter. every night when it goes through the process, you'll get a response email back saying your account's been cleared and it's assigned to somebody. If it is an unfortunate duplicate submission that we have in from multiple agents, we'll also notify you that as well so that you're not left hanging out there. Then it moves into the underwriting process after that. We review many different criteria, like where is it located? What's the crime score? What's the wind exposure look like in the area? If it's out west or in a couple of states, what's the wildfire score look like that? Because that's like a big topic anymore, especially in this country, because it keeps like growing exposure every year. So we definitely want a good understanding of that. Obviously, loss history is key. We do what we can with them, but obviously there's so much loss-free business out there. The more we can get on that, the better. And then overall, the quality of the location. Where is it located? What's around it? What's going on? What have the updates been? Is it a rehab? Is it an old building? Is it brand spanking new? Because we can do it all. We just got to make sure we choose the right ones. After we do that process, if there's something we're missing, we'll follow up with you if we need more. If it's an unfortunate declination and we can't do it, we also want to let you know that as soon as we can, because we know time is key on a lot of these accounts. We don't want to leave you hanging out there thinking we might quote it. So if we unfortunately can't do it, we'll get that declination to you as quick as we can. Then ideal situation is we get your quote in your hands, and hopefully we can work on getting the binder as well. Okay, so moving into the eligible classes. As Joe mentioned a little bit, we're heavily a property-driven program that we want to write the full limits on there as well. I like to point out that we don't really get into any kind of shared limits or anything like that, or offering just primary limits on location. It's either a full TIV or nothing for us on a location. And then if we can also write the accompanying GL if it meets some criteria that we have out there for the accounts, we'll do that as well, because we love to be able to round out stuff for you. But every once in a while the GL doesn't work out for various reasons. But we can always do monoline property and provide that solution for you as well. So we write apartments, condos, and then multifamily dwellings. So the multifamily is 2 to 4 family dwellings. You can sprinkle in a single family every once in a while if it's on a schedule of bigger, apartments or some dwellings. And then on the dwelling side too, we typically don't like very large schedules of just dwellings. They can be, kind of cumbersome to deal with, and there's a lot of in and out off the location stuff. But we can do the schedules. We just, kind of got to keep them in check. When we say non-coastal, so we write in almost all 50 states, as you'll see in a couple future slides. However, we do have restrictions in certain areas, and it's usually the coastal areas. So nothing's an issue on the West Coast. However, once you start to hit in Texas, through Alabama, we skip over Florida and up to Maine, we do have some restrictions. So from Texas to Alabama, for example, we usually try to stay out of the Tier 1 area. There's so much storm activity over the last, so many years. It's just not a win-win situation to be in there. If we happen to look at Louisiana, we're even slightly a little more north. We use that I-10, I-12 line that goes right across the state. So we'll right north of that, but we want to stay out of the southern Louisiana tier. When we get into Georgia to about the Newport News area of Virginia, which is, just north of like the Virginia Beach, Norfolk area, we'll write in the Tier 1 areas, but we generally stay about 20 miles or so away from the coast, unless you're talking masonry non-combustible or fire resistive construction where it's can hold up more to the storms. And then when you hit the rest of Virginia up through Maine, we can get much closer. We can actually be within a half a mile of the coast in those states. And again, we can get even closer to the water if it happens to be masonry non-combustible or fire resistive. If you want to hop back to the last slide, Scott. Subsidized housing is always a hot topic these days. We can entertain it. We kind of look at it as in 3 different buckets. We have the Section 8 stuff. We want it to be 15% of the number of units at any given location. The second part is your Section 42, 67, low income housing tax credit, or LIHTC, which we can call it. We can actually do that up to 100%, which is great. You get into those new construction type projects or major rehabs, and everybody's taking advantage of tax credit stuff with cities or governments. It's usually really good stuff, accounts to write, good stuff. We'd like to see them. And then there's the elderly bucket in there for subsidized. We want it to be more the LIHTC type stuff. We don't really want any low income Section 8 type elderly housing. Mixed use buildings, we're not restricted to just HAB. So, if you get those buildings that are multiple stories, they occupy the first floor with offices, like light restaurant exposures, delis, convenience stores, dental office, whatever it may be, that's not a high hazard type exposure, which typically you don't see with apartments anyway, because who wants to live over a chemical manufacturer as an apartment? So usually it's not too bad. So we can entertain those, up to that 30-33% mark, especially if nice square boxes, 3 stories. We don't want to throw out a risk over a couple hundred square feet of extra retail when it just occupies the first floor. Student housing, it's always been big for us. We love it. We'll do it up to 100% occupancy. I think that's a great place for us in the marketplace. A lot of people restrict student housing exposures these days. We kind of run to it. I think if you look at it right and know what you're looking for and have the right buildings in place, the right controls, good property managers, lower crime areas. So, we don't want student housing in a really high crime like city area or something like that. But if everything else clicks off about the risk, we love the right student housing. 55 and older kind of goes back to the senior housing type stuff. We don't want to do assisted living. We don't want to do any kind of nursing home or skilled medical care type stuff. However, if it is that low income housing tax credit stuff, or it's just pure market rate, it just happens to be geared towards seniors, where everybody's ambulatory. There's no major services being provided, for daily assisted living. We'll go after them all day long like they're normal apartments, and we'll just make sure all the checks and balances are in place. PC 1 through 8, it's kind of self-explanatory. Most of the time we don't want to get out in the rural stuff that's 9 or 10, that can burn completely down because nobody can get there in time. So we focus on those ones. Moving on to the ineligible stuff, we'll hit on some of the stuff that we don't do. I'm not going to focus too much here. I want to dwell on the negative, but there's some key information here to help you guys dial in what we don't want to see come in from you guys. So as I mentioned before, we don't write in every state. So we don't write in Alaska, Florida, Hawaii, and we don't write in the 5 boroughs of New York City as well. However, we do write in a lot of states. Georgia, for example, California, Alabama, North Carolina, Texas, Ohio, and Illinois have been some of our biggest states over the last few years. We continue to grow in every state. That's why we bring on new partners who bring new exposures to us, and we're looking to grow everywhere we can across the footprint. Dilute out the book as much as possible so we don't run into any issues in any states. So keep them all coming. But there's some I mentioned are some of the most popular ones right now. Just being E&S based, we do see a ton of frame, and JM type construction. Heavy frame a lot. We don't want to write any frame buildings more than 4 stories or 4 stories or more that are not sprinklered. We just want to try to protect the book, and those ones, we don't want to write the big thing of matchsticks. That's very difficult to put out when there's a fire. As I mentioned before, no PC 9 or 10. Our main focus on the program, even from a property standpoint, is occupied structures, on a routine basis, high occupancy. So we don't want to be in the boarding, rooming, halfway house, any kind of temporary type housing like situations with some of these accounts. And so we'll stay away from them. Skilled nursing and assisted living, I mentioned earlier, it's just not something we're looking to do. There's just so much exposure with different types of medical issues people got going on that can cause different types of losses from property and liability side. So we'll stay away from that. True vacant buildings, if nobody's living in the building or it's going under a major gut rehab and nobody's there, it should probably be on a builder's risk or a vacant program. If something's on a short period, little cosmetic type rehab and we need to talk about something for short term, we can do that. But just the general sense is no vacant buildings. Going into timeshare, more resort type condos, we typically don't do them just because of, you get the people coming in and out. They have no value in the building. They're just there for a week or a month or whatever it may be. They're on vacation, out skiing, in the mountains out west, whatever it may be. For those of you that have been with us for a while, you might remember we used to write hotels and motels back when we were on the AWAC paper. With the transition, with the pandemic, unfortunately, and the direction that was going, we decided to part way with those classes of business, and we're just focused on the apartment, condo, and multifamily dwellings going forward. Owner-occupied dwellings, usually that's more of the single-family type dwelling, or we don't write secondary type homes. Even though sometimes they fall under the E&S because they might be worth a pretty penny. It's not something we do. I touched on the mercantile part earlier. We're not looking to write big LRO type exposure where it's 50% of the building, no warehouse type stuff or office buildings or anything like that. It's just, habitational with light mercantile. We can entertain the older buildings, which is a nice part of our program. We don't have many restrictions on that other than we want to see them updated. So you get them buildings that are built, mid 80s or older that are, pushing 35 years or plus now. We're going to look for full updates on the electrical, the plumbing, the HVAC, and then we also want the roofs updated more in the 25-year range. If you got something hovering around that age, let's talk it out. I never want to say something's a true decline just because the line's on a piece of paper. If it makes sense, we can always talk to Arch to see if, we can carve something out for a risk, or if unfortunately we can't do it, we'll just move on to the next one. At that time, I'm going to turn it over to Davis. He's going to talk about some of our key coverages of the program. Thank you.
Afternoon, everyone. I'm Davis Halley. Pleasure to have everyone here. Excited to share a little bit about the product. We've talked a lot today about striving to be an industry leader in terms of service. We've talked about some of the risk makeup that we can do, can't do. But something that we realized early on is if we want that best-in-class business, we need to be there with best-in-class coverage. And with how fast-paced the real estate market is, we all know how slow and fast these deals move. We strive to be lender compliant and make that process as seamless as possible. That really starts with our property enhancement, which offers 20 ancillary coverages, sublimits, with some really key coverages, including sewer backup. I know we're always looking for that out there, outdoor property, crime, things to just get the deal across the finish line. And then obviously our business income is full tier, equipment breakdown is available. Ordinance and law is fully lender compliant for most lenders, full A and 10% for B, 10% for C. We can do some variations within that, but it's all ISO based. So, and then to finish out on the GL side, we're able to offer a higher non-owned. A little bit about the risk profile here. We have a 15 mil amount subject threshold, along with a $100,000 premium cap. The general type of average account here is anywhere between 5 and 15 mil in TIV, with an average premium size of around 25K. Not to say we can't do, Joe mentioned earlier, we do entertain items outside of that box all the time. We have a fantastic relationship with Arch, quick responses, transparent responses, so we can understand, their perspective and communicate it back down. And if we feel it's a great opportunity and you have a good line on it, we're willing to take a shot on it with you. A little bit about some of the changes recently. We've made a lot of improvements to the product. Arch has been an amazing partner for this, and we want to be there to catch all the opportunities and to listen and provide feedback. One of the biggest things is expansion of our footprint. This past year, we were able to start to look at entering Texas, and we did so recently, and I'll get into that in a little bit here, but we write across the entire continental US with very few exceptions. Our appetite is expanded to offer a blanket coverage up to 25 mil, and that's offered on a per policy, per location, and per line basis. So it's really opened a lot of doors, especially back again to those lender pieces. And Todd touched on some of those coastal items. We do have some increased capacity on the Atlantic side of the coast, And we can reach out and deal with that on a case-by-case basis, but it's something we're very excited about. Some key coverage additions: we are now able to offer coverage D, which I know is kind of a linchpin item. There we go, for the business income. 180-day EPI is included on all of our quotes. And recently, again, the XWIN Texas product. It's something we're really excited about, already finding traction in the marketplace. After the Uri storm, the big freeze, we saw, markets were in tailspins. People didn't have a place to go with these accounts. And so we listened, we found a solution, and now we're here to write some of those great opportunities profitably with the right mindset. So we actually have a great example of that Todd's going to share with you in a second here, but we're very, very excited and looking forward to a great year ahead.
Great, thanks, Davis. Moving into that, some examples. So I'm going to go over a few examples of some recent accounts we wrote, just to give you a little flavor of what we'd like to do and some of the things we do in our program. So as David mentioned, we have a new XWIN product in Texas, and we took advantage of it on this account. It was a perfect example. It's a property account. It was just north of Dallas, Texas. It was roughly $30,000 in premium. It was like $13 million in total TIV, frame buildings like we normally see. It was one of them perfect examples of, the insurer was an incumbent carrier that decided to restrict or completely pull out of the state of Texas at the last minute. Everybody was kind of jumping ship, and the agent, needed to find a new home for the account in a very short fuse. And it was actually right recently after we just announced to a few people that we were going to do this product, and they said, hey, let's jump on it. We have XWIN market. So, it was one of them ones where buildings fully updated. I had no losses from the Uri storm, which was great. It was all market rate apartments, kind of fit to a T. We got the market quoted up on the fire side with the XWIN, really competitive rate. They went out to one of their XWIN only markets, got the wind side, married the two together, provided the insurer with an awesome solution. It was a very competitive market, and we got the win on that account. Moving on to the next one. Student housing, like I mentioned earlier, something we're very good at. We see a lot of opportunities. This one was about Central Illinois area, property only account. It was like 51 grand. It was about 23 million in TIV on this one, but it was over 10 locations. So this was one where it wasn't a crazy number of buildings, wasn't a crazy number of, it kind of hit that sweet spot, spread out the TIV, so we weren't super concentrated at a single location with the higher TIV. We were able to get it done. Again, this was another situation where, the property manager kind of dropped the ball on their coverage side. The insurer took their accounts back, one placed coverages individually for them instead of having them on some kind of master policy that they didn't have control over. The guy called in. He's like, I got a problem. I really need help with this account. It was last minute. Everything got dropped. They just found out that, the property manager issued. They're like, what can you do? You need to help me out. I'm like, all right, get it in. We'll see what we can do for you. We went through everything. It fit everything, it was all 90s construction. It was all frame and JM. It was all updated, because it was Illinois Central. We used some wind and hail deductibles, got them great coverage, minimized the cat exposure that we had on the risk. And we got them terms in like only a few days. It was a great turnaround, and it solved a huge problem for them. And it helped us win the account, just being able to get, right back to them and help them out with their solutions on this one. And the last one we got for you, this one's in about Central and Northern Alabama. This one's a package, so we did get the GL on this one because it just fit the space. It was about 38,000 in premium, but it was only about 9 million in TIV. It was, 5-6 grand, something like that on the GL side to help round out the account. Not a huge exposure on the property side. Again, this was a similar scenario where it was a part of a larger portfolio before they were blowing it up because they had issues, with a few bad apples, hurting the other accounts. So we took advantage of this one. Where it was a new purchase for this insurer, but it had a great loss history, no problems. The agent came to us again right before the holidays, needing to get everything done. to get the lender, compliant with the risk, so they were good to go for closing. We were able to turn everything around quickly for them. Again, similar scenario to the other ones, fully updated buildings. Because it was in Alabama, so we used a little bit higher. We used a 25K AOP on this one, and we used a higher wind and hail as well to help protect on the cat side from the storms that you can see down there. Again, getting everything in their hands, getting it all agent compliant, lender compliant, for the insurer was able to get us to win when it went to a closing a few weeks later. It was just a great win. These are just some examples of what we see. This is the normal stuff we see on an everyday basis. These are great risks that we were able to do. We see stuff like this, but hey, don't take my word for it just on these ones. Here's some great comments from some of our agents. I'm going to turn it over to Joe.
Absolutely. Thank you, guys. That was some great information. I really appreciate your detail level, drilling down to those recent wins and some information related to the eligible classes and coverages that we offer. And again, take some time to look at, we're not only here just to create revenue for ourselves and our carrier, we're also here to make sure we create revenue for you, making sure that part of your business plan, calls for growth, and partnering with a team like HabPro and the gentleman that you see here will help you get to those goals. We really believe we separate ourselves from our competition. We talked about the product. We have in-depth product forms, coverages. We work with an A-rated carrier. We talked about work with Arch, who we exclusively write through. You could go to the next slide. So Arch is our exclusive partner, where we have the ability to work with. I think you want to get to one more slide here. I just want to get into that real quick. Okay, never mind, just stay right there. So I just want to talk about, we covered a lot of business here. We talked about the forms, we talked about the product, we talked about the people. You got to be some of them, and then also about the pricing. We start with an ISO-based product. We go off of the rating there, and the fact that we don't have those legacy issues that you see from other carriers. And you see that when it comes up for renewal, you get increases of 25, 30, 35%. Those agents, their carriers are trying to fight their way through some unprofitability. And with starting in 2018, we don't have those issues. We have a robust rate. We look at a risk and say, does it have the risk characteristics of an average or above average account? And then we start to price it based on those characteristics. So that's the kind of team you're dealing with. And it's committed to service, committed to our partners, and creating the best-in-class partnership that we possibly can with our agents. So a little bit about getting appointed. We talked about having people on here that are already appointed for and work with our product, but there are also others that are listening, and we welcome you. And how to get appointed. The first thing, really, again, you have to realize we want to work with partners that have a portfolio of habitational business. Then we work with retailers and/or wholesalers. And then we're committed to growing together and creating a solid book of business. It's not always about the top line, the written premium. It's about long-term growth, profitability. So if you're interested in partnering with us here at HabPro, we'd love to have you join. So next steps, here's my information. You can either email me or call me. We can get on the phone and talk about the onboarding process. So we'd like to open it up to some questions and certainly some answers and feedback. So Scott, would you be so kind to allow everybody unmuted? Anybody like to start with a question? Wow, I was expecting a ton of questions for today. All that great information.
Yeah, I have a question. I have a question. It says Steve Reiser with Alliant. What's your stance on aluminum wiring and stab lock boxes?
Sure. Part of our portfolio, we do allow remediated aluminum wiring. Todd, would you like to jump into some of the accounts that you've seen with that?
Yeah, I mean, like Joe said, we definitely allow aluminum wiring. It has to be remediated using, one of the acceptable methods that's out there, at the, electrical boxes. Um, as for the second side of that, we try to stay away, or we do stay away from the Zinsco and Federal Pacific type breaker panels just because of our historic issues that are with them. It's not something that we historically want to take on in the program and have. So, we ask those questions up front. We usually make our quotes subject to them not having them, so it's something you're aware of. If unfortunately we find them on the back end because somebody didn't know they existed, we'll take corrective action on the account and work with you, on a solution. So hopefully that answers your question for you.
Yeah, just to follow up, is pigtailing okay, or is that to be a couple of them? When you say your remediation of the aluminum wiring, just curious if you can clarify, that would be great. Thank you.
I mean, ideal, it's the better, more modern, scenarios, but it wasn't that long ago where pigtail was the acceptable method, or the primary method. So, if somebody only did it 10, 15 years ago, kind of thing, it's most likely pigtail because that was the predominant method at then. If everything else checks out about the account, we'll work with being on pigtail.
Hey, gentlemen, how you doing?
Oh, sorry.
Please go ahead.
Just a quick question. If you're open with NSM and we've historically done business with you, do we have to set up a separate contract for HabPro in particular, or do we have access to it?
That's another great question. No, you have access to, if you're contracted currently with another program, kind of like the plugs I was given for my colleagues and their program, you do have access to HabPro. However, we'd like to start by having a conversation, talking about what kind of business you have, the portfolio that you guys write. Again, we're looking for a consistent flow of business from our partners, but absolutely, you're contracted, you're open. We just would love to talk to you about the specifics about the program. And also remember, the submission inbox is listed on here for you to send it into. So HabPro@nsminc.com. So that goes into there, it gets cleared, and we quickly get you a response of who's working on it from an underwriter perspective.
Okay, thank you.
I had McCool here. Other than the 5 boroughs, is there any place else in New York that can't be written?
I'm sorry, I got caught half of that.
I said, other than the 5 boroughs in New York, are there any other areas that we cannot write in New York?
Oh, so no, right now the prohibited is the 5 boroughs. We do have coastal guidelines from Maine down to Virginia. In New York, we see a ton upstate, but we are, we do see, outside the 5 boroughs, we do have an appetite. So yeah, that the limitations there are the boroughs.
Thank you.
And we do typically stay away from Long Island business, just to point that out, as well as an extension of the 5 boroughs.
Yeah.
Okay, so if there's some business that's not near water in places like Great Neck or basically Nassau County, so just no 5 boroughs and no Long Island?
Yes,
Correct.
that'd be typical.
Got it. Thank you.
I have a question more specific to condominiums. You mentioned buildings that are 35 and over. What level of updates are you really looking for? I mean, traditionally in condominiums, it was a little difficult to get anything on the inside updated. What really would be ideal to be able to write, anything 35 plus?
Yeah, great question. I would say 30-40% of our book is on the condo side. So the way we view a property risk is similar in nature to an apartment, a condo. I know sometimes it's difficult to get information. On the condo side, we do the walls out. So we see ourselves looking for the same type of updates. The electrical, plumbing, all within 35, roofing 25. So we really do have the same similar expectations of property risk. Anybody, Todd or Davis, want to add anything?
No, it's pretty much dead on. I mean, I know the hard ones are probably, the stuff that's built in the early to mid 80s because it hovers right around that mark. And typically a lot of times you don't see them updated. Obviously, the electrical is probably the biggest, one as well, because the way the unit owners, control some of that stuff. So, it can be difficult. It can be, one of the biggest sticking points for us on our condo business is that maybe 75 to 85, year range of construction, just because it's in that close window and you don't see it a lot, and if you get the much older stuff, it's gone through some kind of rehab at some point. So, and obviously newer, we're just focused on the roofs at that point if it's, shorter than 35. So, it's kind of one of the hard areas, but, we do what we can with them.
Great question. Thank you. Anyone else that has anything they wanted to ask?
Yes.
Yeah, a quick question. You mentioned crime scores when you go over an underwriting guidelines. I'm in Memphis, Tennessee, and this lovely place. We're never more than a few blocks away from a high crime area. Zip code, and I mean, some zip codes matter, but in others, there's no real difference. I mean, you can have $1 million homes in a high crime area, a few blocks away. How big of that is an underwriting requirement? And is that more of a thing just that limits GL, like causes maybe an A and B sublimit, firearms exclusion, or is that just outright kill eligibility?
Yeah, great question. There's some really good ones today. We do have a max crime score, and we do know that there's certain good sizes of the tracks than others, and they're really close in proximity. But it is a hard stop. We really commit to knowing that we don't write coastal, so we write more metropolitan, and we get all that. But we also think there's a lot of business out there to be had. So what we really target is, that business that is falling outside the admitted markets. And yes, it does have some higher crime score, may have a higher crime score than an admitted book, but we really don't target the ones that have, over a 60, 70% crime score. We have limitations, and we drill down. And getting back to whether it do property or casualty, we review both. We review crime to property, we review crime to people, and we take that into consideration when evaluating a risk. It's a pretty in-depth review, looking at different sites and our internal applications. We have the ability to get drill down real deep, but we also use the internet and to find some reviews about an account. So if we take a look at it, okay, it's a crime score, it's borderline. Well, we go into the search for the insured, the location, and then we find some information related to that account, the review on the condominium of the apartment, and we put that into perspective. So there's a lot of different tools that we use, but when it comes to a certain crime score, is it a hard stop? Most of the time it is. We believe that there's a lot of business flowing in this class of business, and we really are targeting that best in class. So it may kick it out if it's above a certain threshold.
And in terms of metrics, I apologize, I missed your name, but we use a risk meter platform for crime, which I'm sure you're familiar with. Provides a lot of subcategories, both on the property side and on the GL side, also on vehicle theft. But that we use that to do our deeper analysis to get a little more granular, specific to the location, not basically taking a zip code approach, because that really that doesn't tell you a whole lot about the risk itself. So.
Perfect. That's exactly what I wanted to know, because the zip code kind of negates most apartments here, but when we drill down to by address and more in depth, there's definitely some opportunities.
Yeah, and we have noticed that actually specifically in Memphis as we transition to risk meter, really opened a lot of doors because there's some really nice areas. So it's a great example.
Excellent.
A question for you.
Fellas, we actually have a couple of, I know that there may be some additional questions out there. Scott, who is running the tech for this presentation, sent over some questions that are in the chat. So I figured maybe I'll read off a few of these.
Perfect.
I'll answer what I can immediately, and just pass it off if there's anything else. So first here I see, do you write in Florida? If so, how far from the coast? We do not write in Florida. So the second half of that question is 0. Also, so yeah, there is some, I guess maybe market distortion confusion. There is another program here at NSM by the name of Champ, who you may have seen, who they do a ton of Florida business, a ton of coastal business, true coastal business, true cat business. And they are a direct-to-retail program. If you're interested in learning a little bit more about that, reach out, or also that they can be reached through our website, but it is a closed access program as well. There is a non-coastal, how about Isabel, Texas? I am not familiar with where Isabel is, but we typically are staying away from any sort of coastal tier 1 or even tier 2 Texas business. Like I mentioned it earlier in the presentation, we're ex-wind in Texas, so really it's for that inland risk where you are splitting perils as a result of some of the marketplace distortions that have happened over the past couple of years. Buildings on piers, we do not do those. Anything on pilings over water, our form does not support it. It's not something that's within our appetite. Regarding tier 1, specifically Texas to Alabama, can you consider quoting locations in tier 1, excluding all windstorm? There's a lot of opportunity there right now. There are cat wind markets that will write the wind, but don't want the AOP exposure due to habitational occupancy. That's a great question. It's something that we get asked constantly. There probably was a time that we perhaps would consider some nicer tier 1 ex-wind risks that were not truly coastal. But at this point, we do not write tier 1 business even on an ex-wind basis in the Gulf. Okay, do you have an age limit on the buildings? No, is the easy answer. The more complex answer is, once we start to get toward that 1900 mark, we really start to look for a verification of gut rehab. We want to see that there has been some sort of major improvements been done to the structure at that point that not only is affecting the cosmetic piece of it, but obviously the structural elements at hand. Let's see. Unit owners in an association are renting their units to third parties. Does the HabPro program have any kind of percentage cap for rentals? Todd, do you want to take this one?
Again, the simple answer is no. However, when you got a condo, one, we want it to be the unit owners that are doing it. We don't want the association involved in the process because that opens up a whole other world of exposure to the association that basically our rating philosophy doesn't contemplate. It depends on the risk because, obviously you're talking about 10% on, a 10 unit condo building is much different than 10% on a 200 unit condo building. So the percentage number is never exact because there's always, whatever the risk is about. But once it starts creeping up too high, we may increase rate, because there's, too much tenant exposure, that opens up more stuff to like slip and falls and that kind of stuff because they're not necessarily the unit owner. So there could be more of an inherent risk after a little while when it gets too diluted versus tenant versus owner. So, we take all that into consideration when we look at the pricing of the risk, especially on the liability side of the house.
Here's one. Is there any chance on habitational accounts that you will be able to offer abuse and molestation coverage or assault and battery? The quick answer to that is we do not offer, we exclude abuse and molestation. On the assault and battery side, we offer a 250 sublimit for A and B. Sometimes we tamp that down to 100, if, depending on our risk analysis from a crime standpoint. But we are not silent on A and B. we realize that does create, some issues for umbrella, et cetera. But we have seen a considerable uptick in our package business over the last year plus. Just the ability to offer that one-stop shop product has served us well for sure.
Hey, Davis, can I add something real quick? Is that,
Sure,
yeah,
sure.
we have seen an uptick in our package writings. However, a lot of times we are a solution for the monoline property piece. And when there is such restrictions on when you have a need for some coverages that we don't offer the $1 million limit, we have a sub limit. We do see ourselves as an option for, if you break up an account and with the property and casualty, and that's really, one of the things that I was surprised at when the need for having a package solution, but also what the surprise was that from a competitive standpoint, there's still a lot of carriers out there that are targeting that GL business. And for us, we do look at ourselves more of a best-in-class property writer. So I would say that 80% of our book now is property. And first of all, the premium's a little higher, of course, but from a premium perspective, we see ourselves as a bigger writer for the property. So when there is an opportunity to split the count, always consider us if the sublimits don't meet your needs or the limits don't meet your needs, that we can give you an option for a monoline property.
Here's a question regarding flood and quake. I think that's an important one to touch on because we get asked about it all the time. We do not currently offer flood or quake. It's not something we have the ability to do at this time. It's not something we're pursuing either, but we'll see what comes down the road. There's a question here about, can you consider writing a single family dwelling if owned by an LLC, primary resident coming off of builder's risk? Example, $36 million steel concrete home in LA, California. Wow. Number one, can I move in? Number two, no. We can't do that. So owner-occupied single-family dwellings are not within our appetite. Basically any single-fam, duplex, triplex, quad, standalone locations are really sort of an ancillary play for us. It's something that maybe is on a 5 or 6 location portfolio that they pick something up over the last year or two, or need something for a year as it transitions and they can get it onto a master. It's really not something that we focus on, that specialty single family dwelling. Are there any verbal questions out there? I'm just rifling through this list because we.
Oh yes, I have one. I was wondering about the state of Oklahoma and what percentages of wind hail deductible you're doing there at this time.
I could take that one. So our guidelines, that we have set up with Arch, can be a little restrictive come Oklahoma. We basically have a $50,000 minimum per building wind hail deductible in Oklahoma. So I usually say, unless the schedule is predominantly made up of $1 million to $1.2 million, 5 limits or greater, it can be very difficult because then that 50,000 wind hail deductible turns into 10+% when you're only looking at $300,000, $400,000, $500,000, $600,000 buildings. And we're pretty upfront about that when we see the risk and communicating with you to make sure it's something that you still want to proceed with. Just because I know it can cause some issues with lenders. Depending on what markets you have, some people will go purchase buy downs because I think when we can quote, we have pretty competitive rates in the state compared to some others out there, but we just have the higher deductible to work with many times.
Thank you.
We're getting close to our 1 hour time limit. We still have 6 minutes, but I encourage any question. But as we get closer to that time frame, if we don't get to your question, please know you have our contact information, and we'd love to talk to you via email or phone. So let's continue. I just wanted to let you know.
Sure. Question here: are there any solutions to cover stab lock breakers, Federal Pacific or Zinsco brands?
Okay,
not at this.
Go and then go to the next one. No, I'm just kidding.
Yeah, not at this time. I know that some of our competition offer, large retention opportunities for those types of exposures or exclusionary wording altogether. Currently, we do not have the ability to underwrite those or an interest. We ask ahead of time for verification of whether or not they're in place. If they're identified upon inspection, essentially we have to get off as soon as possible, unless they are willing and able to immediately replace them. So it's not something that we're looking to hop into. Let's continue through here. Is there a limit to the percentage of assisted living units for an account? It's 0. We don't write assisted living, or nursing exposures. So that's an easy one.
Again, if anybody has any verbal comment questions while we're going through these, just yell out again.
What about occupancy in general? Do you have a minimum there?
70%. Well, it depends on the general for an everyday structure that's just out there and being renewed or moved. It's 70%. If it's new construction or coming off like a major gut rehab where the building was vacant, we can do up to 50% the first year, and then the second year we would expect it to be up to 70% or greater.
And if that's property only, still 70%?
Yes, it doesn't matter if it's property or package.
Thank you.
And again, some of them, once even the apartment buildings, if they went through like a new ownership or something changed about it, and there's a ramp up period, and they already have so much of a pre-lease, but it's just falls short. Like we can talk about them. It's always not just a hard line in the sand if it makes sense. Where we know it, within a few months or something, it could be 100% full, but it's not today or something like that. So, we don't want to just throw the baby out with the bathwater with a hard line on that one. Let's talk about it if there's a story behind it.
Okay, we got enough for 1 or 2 more questions.
Is there a tenant insurance requirement for the habitational risks?
What was that?
Is there a tenant insurance requirement for apartments?
No, I don't know. I have to talk to you separate that to really get to know what you're asking. Davis, did you want to say anything? Looks like you're ready to say something.
Sure. We prefer, tenant coverage to be in place, renters insurance. It's not a hard line in the sand, but it's something that we do ask.
Thank you.
We realize, there are a lot of, habitational is so interesting, right? I think we all know, because there are local requirements and state laws and all these things of what can and can't be required in a complex. So you take like California, it's a great example of where it can't be required. So it's one of those things. We take it on a case-by-case basis.
Awesome. Well, this is going to conclude our presentation for today. We really appreciate everyone's questions, everyone's involvement. I want to thank Todd, Davis for their excellent presentation. Just to share with you what we're growing here in HabPro. We certainly believe we penetrated in many states. We still have more to go. We think we penetrated in a lot of offices out there, but it's obvious that there's a lot more to go. And a lot of the best agents that are out there are on the call right now. And if you want to talk about an appointment, find another product that helps complement with what you have today. I would love for you to reach out, and we can go through the appointment process, talk more about what you see on a routine basis, and get into a little bit more granular information about our product. And to our marketing team who put this all together, what a wonderful job. And I appreciate everything you had done to set this up. And without any further ado, I want to thank everybody who participated on the call and value your input, your partnerships, and maybe future partnerships. So thank you, everybody, very much. We look forward to talking to you down the road if that's a need that you have. So thank you and have a wonderful day.
Thank you, everyone.